It has been said much before me that a great differentiator between investors is whether one's focus of analysis is that of return or that of risk. A poor investor hunts return, while a sophisticated investor manages risk and allows return to follow. Yet risk is a quite abstract and intangible object to track. Many investors, certainly great quantitative investors, speak of statistics and probability. A more statistical view of risk has given rise to a focus on notions like the standard deviation of returns and VAR, value at risk, and its associated derivations. For example, conditional value at risk, or tail value at risk. I propose, however, that a proper appreciation and appraisal of probability distributions is the mightiest of these such tools and exists mostly misunderstood and underappreciated. Volatility and standard deviation are the metrics most utilized in the calculation of risk-related performance, the Sharpe ratio being foremost. In this approach, the volatility, being the fluctuation of an asset's market price over some period, is the object of risk. So, the thought goes that should an investor need to liquidate a position, then a more volatile asset presents a greater probability of loss than a steadier one. If an investor had $1 and hoped to grow it over a year, knowing that he would require at least 90 cents at the end of the year, and is presented with two options. The first, a short duration treasury bond yielding 4%, or a share of common stock, then the investor under such constraints would most likely be inclined to invest in the bond, as there the likely volatility of the bond and related probability of dropping below the investor's needs are far lower than the stock, which may make large moves over a given year. In the safety of seeking lower price fluctuations, the investor gives up the greater potential gains commensurate with larger fluctuations to the upside. Further, the investor may choose to liability match with a bond of equal duration to his liquidity needs, removing price risk from the equation and taking on only default and credit risks. I will use an admittedly absurd hypothetical to call into question the nature of volatility as risk. If an investor were to acquire an enormously volatile stock which swung by 50 to 99% each day, yet the investor knew that the stock would never drop below the price of acquisition, then would that truly be a risky asset? It is enormously volatile, yet there would be no possibility of loss relative to the initial investment. Of course, in reality nobody could be certain of such a thing, so it seems that it should be a moot point. It does, however, raise the question as to whether volatility is the correct metric for risk analysis. How about, then, an investor who acquired a stock with great potential upside? The investor this time has $110 and knows that he needs to have at least 95 at the end of the year. The investor buys 100 shares of a stock trading at $1 and pays $10 for a put option with a strike of 95 cents, allowing the investor to sell the shares for a total of $95. The total value of this position may swing wildly, yet is this truly a riskier position for the investor when compared to buying something as seemingly safe as a treasury which bears duration risk? What if interest rates were to rise greatly? In this case, the wildly volatile portfolio may even be safer to the investor than a seemingly safe treasury. The investor in this case has not eliminated volatility, but has secured protection against the outcome which would be most detrimental to him. No, volatility doesn't seem to quite cut it. Standard deviation less so, as it merely includes 68.2% of observations about the mean. Risk appears to be a situational matter. I will note that in reality such an option would likely be priced a bit higher, and implied volatility is an aspect of an option's price. The numbers I have used are only intended as a clean and simplified example for a more general concept. Value at risk, VAR, seems to address many of these shortcomings. Value at risk describes an approximation of potential downside risk. It is a metric of the left tail of a probability distribution. The first trouble with VAR is that it leans on those same volatility metrics to arrive at a value in the first place. More fundamentally, however, VAR is typically calculated assuming a normal distribution. What in reality ever truly forms a normally distributed curve of outcomes? An approximation for many circumstances? Very possibly. Where tail events are concerned, however, approximations of normalcy are insufficient. The increasing adoption of shortfall risk metrics, too, appear as a step in the right direction, and I believe that they, in fact, are. However, we continue to arrive not at a statistical problem, but one with cognizance. Distributions of outcomes cannot lend themselves cleanly to statistics, and even while approximations usually suffice, they become increasingly deceptive when dealing with true conditions and especially with extremes. To illustrate an alternate form of probabilistic thinking, first consider the process of making a substantial life decision. Investment decisions may use statistical metrics in their consideration, yet their outcomes are ultimately distinct events as they are in life. Say you were presented with two employment opportunities. How would you appraise their potential risks and benefits? There's no standard deviation, no value at risk, and certainly no normal distribution. And yet, laid out before you is a distribution of potentialities. The probability distribution remains where the statistics either do not or are empirically untenable. The notion of a probability distribution is more fundamental than statistics, and statistics are only a crude attempt to approximate probabilistic phenomena. The distribution of probabilities is a field of all those notions that make up what if. Now, are those probabilities ontologically true objects of reality? That I don't know the answer. However, they are a very useful tool to operate with as guides. Options branch out to create a conditional field of possibilities. Perhaps in this case the right tale is that one company will award stock options that earn many millions, while the left is that the company collapses in scandal, leaving you unemployed with a tarnished resume. Perhaps the most extreme tales are that one company's office has a catastrophic fire, leaving you dead, and alternately, that you are made CEO on day one with a $100 million salary and billions in stock options. Those most extreme tales typically end up in the realm of neurotic paranoia or daydream fantasy, and yet in some sense they do exist. Every point in time branches out before in a spread of possible outcomes, branching out from terrible to magnificent, and intuitively we know this, even if we typically are not cognizant of the entire array. In investing, the analysis of standard deviation and tail risk attempts to get at some sort of underlying field of potential outcomes. However, in the example of the one-year investor, we noted that variability of intermediate steps and movements may not necessarily relate to the distribution of outcomes. The investor in this case needs to concern himself with the distribution of outcomes for his net portfolio position, considering potential equity upside plus any residual option value should he sell his shares first on the last day of the holding period, and to the downside, instead must consider the counterparty risk of the option. Volatility here plays very little role in the left tail, as volatility of the portfolio itself is not what concerns the investor. Shortfall does. The investor must instead consider an array of outcomes branching from the stock price collapses, and so too does the counterparty to the put option, all the way to the stock climbing greatly in price and a strong recoupment of option premium from Vega. Without a clear standard deviation nor normal distribution, then how can one weigh potential outcomes? Consider this example, which was recounted by Marc Andreessen from a reported conversation in which Sam Bankman-Fried was discussing the propositions of effective altruism, a novel utilitarian philosophical movement which has gained notable traction within the tech sector. The question was posed to him that if he were given a weighted coin such that it would come up heads 51% of the time and tails 49%, would he flip the coin if it were to yield an entirely new Earth when heads came up, and destroy the existing Earth if it came up tails? It is recounted that he said the expected payoff was 0.51 times 2 plus 0.49 times 0 equals 1.02. And therefore, since the anticipated outcome was to yield 2% more Earth, then he would indeed flip the coin. The question was posed again, as to whether it should be iterated assuming that the first coin flip came up heads. Now with 2 Earths, the coin flip's expected payoff is 0.51 times 4 plus 0.49 times 0 equals 2.04, and therefore the coin should be flipped again, and again, ad infinitum. This is a self-evidently insane way to view the probability distribution of outcomes, and it would be sophistry to try to defend it. We intuitively know that this is wrong. Perhaps we could consider it thus, that the actual payoff looks more like 0.51 times 2 plus 0.49 times negative 1, since the loss of an Earth is an active outcome of adding a loss of 1, and not the active addition of some sort of neutral non-Earth, giving us 0.53, or roughly more than half an Earth. The outcome which we intuitively go to. I am by no means attempting to rewrite the rules of mathematics here, but simply to propose that there may be some qualitative nuance to how we assign values to events. We can go further, however. We instinctively know that some worse outcomes should be overweighted in consideration relative to moderate outcomes. Say you were presented with 500 boxes. Each one had 5 cents in it, but one of them would immediately set you on fire. You would probably be a lot more concerned with her 0.2% spontaneous combustion risk than the 99.8% chance that you are about to suddenly find yourself the owner of a shiny new nickel. Why? Isn't your outcome almost certainly that you will make money? 0.998 times 5 cents plus 0.002 times magical inflammation equals 4.99 cents and barely more than a spark. Would you really be afraid to go near a nearly extinguished candle to pick up 99.8% of a nickel? But of course, that is so unreasonable that I'm apologetic for even humoring it. This way of attempting to collapse potential outcomes into one aggregate expected payout is not sufficient. So what do we do with this probability distribution? I propose 4 fundamental steps. 1. Attempt to estimate placements on the distribution. 2. Examine conditionality. 3. Group like with like. And 4. Consider extreme tails uniquely. The comprehension of a given probability distribution first begins by considering the start point. What outcomes immediately branch from it? Say one were to acquire a share of an S&P 500 index fund. The immediately evident branches from the initial decision would be an array of outcomes at the end of any given holding period, from a loss of 100% to a theoretically unlimited upside. This presents us with an immediate problem out of the gate, as we begin with an infinite right tail, and if you're going to spend your time contemplating the nature of infinity, it's best to instead settle into a monastery for a life of meditation. In reality, there is no true infinite upside. It is ultimately capped by the fraction of ownership which you have acquired, bounded by the total value of human enterprise, if the index were to somehow encompass all of it. So what is the theoretical maximum of the sum total of human enterprise? We're stuck at infinity again. We have to deal with this infinite right tail, or it will just keep asserting itself. To do this, we have to get practical. We must not give a weight quantity to the infinite upside, or else we will be constantly stuck with it. So we must take it to approach zero, and for practical purposes, to be zero. Now the infinite is weighted such that we may ignore it. Next, we must consider a reasonable right tail and where it begins. In the case of a 1-year holding period of the S&P 500, we must use reason from history and take the highest that 1 year has ever returned, 32.06%, and take some multiple of that can still be bounded by reason. Perhaps we decide to double it, 64.12. Is it reasonable to decide to imagine a return greater? Not really. So we can tuck it away as a truly unlikely outcome not worthy of any real weight. Now what is the worst outcome? That is that 100% of the investment is lost. We arrive here at a crossroads of competing impulses. The first is to weigh catastrophe greatly, and the other is the obvious, yeah, but I can't imagine that happening. Well, if the S&P were to go to zero, then that would mean that the top about 500 companies in the US were worth $0, meaning that there's no industry in the entire country. It would not actually matter where your money was at that point, so you can discard this as irrelevant. We should instead proceed with a downturn commensurate with reason, based on reasonably applicable history or derived logically from reasonable potentialities. The moral of this story is to weigh catastrophe greater when it is needless risk, but when it is a mere part of life or endeavor, do not allow yourself to become too neurotic. We weigh the firebox higher as it is a catastrophic, needless, and obvious risk. Yet if we pay too much mind to the possibility of everyone vanishing at once, we become needlessly catatonic. Caution may be a virtue, but fear tends to trick. Keep a level head. I must note that hard to imagine things do happen all the time, and even common occurrences in history seem unfathomable to people in a different time and place. I'm a proponent of caution, but caution itself must be cautious, as fear is a whole different animal. Caution comes from the head, fear from emotion. Now that we have the extremes out of the way, we can begin to look at the bulk of the distribution. How do we place the array of outcomes worthy of consideration? I find that using history is the first and best place to begin. For the sake of this first step, we can imagine that we'll be thrown into a random year of the S&P's return, and we will get that return. What does that look like? Considering only 1-year returns, we simply are looking at each historic yearly return as an outcome. We can add more data to this by adding more observations, years beginning each month, thus multiplying our years by 12. This can even be done down to the day, until we are satisfied with the number of observations. Here we can build a 1-year return table. If we weight them by frequency, we now have a simple 1-year return distribution curve. We can add to it theoretical returns which we have reason to. This will most likely not vary greatly from the historical curve, but may be shaped by expectation. If we know where we are in a market cycle, we can increase the rate on comparable observations and add in those arrived at by reason. If there are novel circumstances, then we may add in weighted outcomes by reason associated with those novelties. This gives us a crude history-based distribution adjusted for circumstance and fleshed out by reason. This ability to weigh and add outcomes by reason will ultimately be differentiated by the experience level and skill of an investor. Unfortunately, I cannot offer a clear rule set for doing this step, as it must be arrived at by reason, skill, and experience. We then arrive at our second step, the examination of conditionality. Many outcomes may be contingent on others or may be excluded by the occurrence of another. It is common for there to be concomitant conditional outcomes. This forms the basis of conditional probability. If a practitioner is attempting to build a large data table, then this can be done to a very granular level, where each observation and possible outcome is adapted to its contingencies, but thinking in a probability distribution does not require this. Consider the example of an investor who has just witnessed a stock market crash. The investor has looked at prior observations and weighted likely outcomes by his current circumstance, adding weighted potentialities from reason and experience. The investor has a portfolio of 50% S&P 500 index fund and 50% treasury bonds. The recent market crash has left the stocks trading at very low multiples, while bonds have been piled into in a flight to safety, now yielding 3%. The investor would have a distribution of possible outcomes which all have unique outcomes for both the stock and bond positions. The investor in this circumstance must consider conditional outcomes like the case of the Fed drastically cutting rates. Say the bonds have durations of 3 to 10, and the equities are at a truly cheap average price to earnings of 11. Then it would be reasonable to assume that an aggressive Fed rate cut down to 1% might give those cheap stocks the juice they need to rise in price and would lead to a sizable price appreciation for those bonds with a new target rate far below their yield. In this case, such a scenario as a rate cut leads to outcomes which will most likely occur together. Now, it is not certain that both will happen. Perhaps the Fed attempts to cut rates, but the Treasury defaults and some major equity market makers go out of business. There is very seldom perfect certainty in these concomitant outcomes. Yet we should give this sort of concomitance great weight in the distributional space which we allot to the potentialities of such a rate cut. Here we are considering the rate cut as the main object in the distribution and not the joint probability of both stock and bond gains unto itself. In this example, the joint probability is secondary to the potential outcome of a rate cut. This is the consideration of an object behind coincidence. The second type is the if-then relationship. This is the conditional probability, where A is conditioned on B. This allows us to subdivide sections of the distribution by if propositions. Say an investor holds shares in a company and expects that in most outcomes the stock will see at least modest appreciation with some 15% chance of fantastic gains. Yet there is an estimated 4% chance that a long-shot lawsuit will badly damage the company. The outcomes which are contingent solely on the outcome of the lawsuit's success must first be considered as a distinct distribution of outcomes weighted by their own probabilities assuming the suit's success, and then only after can be added to the overall distribution once each area of that distribution is weighted by the probability of the lawsuit. Here we are grouping sub-distributions by the weight of the necessary precursor events. Group like with like. When running through outcomes, you will likely find that a great many are functionally equivalent. When this is found, it is reasonable to simply add them together and treat them as one potentiality for the ease of keeping everything straight. Say we are facing the ludicrous 500 boxes of nickels, only this time there are 50 with nickels, 50 with 5 pennies, 100 with dimes, but you must pay a nickel to get it, 100 with a stone that's worth 5 cents and 1 penny to cover the transaction cost, and so on like this. These are all separate and unique outcomes, but really their differences do not matter. So too is this found in investing. Take sequences of corporate events. One sequence where the stock likely declines 10% then rises by 20, and another where it declines 5% then rises 13.68. If you are indifferent to the intermediate nuances, then they may be clumped together as one functional outcome. This may even allow for distinct precursor events of contingencies to be grouped together under some circumstances. If the differences don't functionally matter, then like is best treated as like. Last is when we address tail extremes, which we cannot simply wave away with a null weighting. This is a very personalized process, and I cannot attempt to create a generic rule set. The value of each extreme good and extreme bad within the realm of reasoned possibilities will bear unique rewards and harms. Here we come to a major problem with the more common statistical methods of analyzing investments. Is an extreme good equal to an extreme bad? In the case of the disappearing Earth, we reasoned that the downside was too catastrophic to take the risk of a 51% chance of doubling humanity. This may be the case for an investment. Imagine a bimodal derivative priced at 50% of par. There are two equally likely outcomes. Either A happens or A does not happen. If A happens, then the derivative expires at par, paying out $1 on every 50 cents put in by the investor. While should A not happen, then the derivative expires worthless. 50% chance of a 100% gain and 50% chance of a 100% loss. Survey data and market research indicate that most investors would not take such a chance, as they would consider the 50% chance of a 100% loss to be worse than the potential gain. This is particularly obvious if we consider an iterated game. Imagine a 50% chance of a 1000% gain and a 50% chance of a 100% loss. If this trade were iterated, then almost certainly, regardless of any fantastical gains the investor had accumulated, the portfolio would go to zero, as any 100% loss is impossible to recover from. No return, no matter how large on zero, will ever exceed zero. So total loss holds a unique place of risk. That's it, the game ends. How about if the same opportunity were presented with a 50% chance of 1000% gain and 50% chance of 100% loss, but this time the investor is only allocating 5% to the trade. Now the same distribution exists for the individual position, and yet catastrophic total loss is removed as the investor still has the remaining 95% of the portfolio. This sounds much more reasonable. What do we make of this? The first and most obvious answer is that a portfolio approach to investing will likely be superior to an individual position-based approach to investing. More than that, however, it reminds us that we are not really dealing with calculations of individual trades, we are instead dealing with a distribution of overall outcomes. If a desperately poor man has $1 and cannot buy anything he needs, yet has a chance to invest that $1 with a 75% chance of total loss and 25% chance of a 1000% gain, then we are still in the same situation as the total portfolio wipeout, this time with even lower odds of winning. Yet most people imagining the circumstance would imagine that a 75% chance to lose your last dollar you can't buy much of anything with anyway, is worth a 25% chance of suddenly having $1,000. These seem incongruent, and yet we intuitively know that they are different. Here I will make two general claims. First, investors who are too reliant on raw statistics miss out on obvious realities such as this, and neglect the reality of the probability distribution. Second, investors should also not be too quick to rush into those intuitive feelings. Very often, common sensibilities of risk and reward result in irrational exuberance and neurotic anxiety. What the holistic probability distribution approach implies is neither. Extreme rewards and risks must first be considered in the context of their reasonability and probability. Once they are considered, raw quantification is insufficient to get all the way to an answer. The extremes are not mere quantities. They are qualitative events, and it is incumbent on an investor to think carefully and rationally about what they entail, neither bending to emotionality nor becoming blinded by raw quantification. The probability distribution is a bit slippery. A true appraisal of the outcomes before an investor does not cleanly lend itself to statistics. I by no means wish to denigrate statistics, merely to point out that in practical reality, they are insufficient to consider a distribution of possible outcomes, nor sufficient to analyze their true implications. This requires a degree of both rational and intuitive thinking on the part of the investor. Extremes do not behave like other values and vary greatly by circumstance. They must be considered as whole events and not outcomes or expected payoffs, and the array of potentialities as a whole must be respected as a rather ethereal object and treated with the appreciation it deserves. There are no shortcuts. To think in this way is a practice that takes time to build. This is my proposition here, that a great investor, by necessity, is one who has learned to think in this manner.